Greetings, everyone. This is Bob Kramer giving you your November economic update. Well, it's been a little time since we've talked about the markets, and in general, this year has been a very, very good year for just about all of the indexes. The one that we refer to most is the S&P 500, which is at this date on November 4th, just about 16% off its lows from the beginning of the year. So very good year, 16% in a year is outstanding. However, I want to share with you a term on another index called the breadth of the market. Now, the breadth of the market talks about the market participation. How many stocks are participating in positive momentum or negative momentum? And I'll share this with you. Way back in August, on August 22nd, the stock market, and I'm talking about the New York Stock Exchange. The New York Stock Exchange has about 2,300 stocks, so it's much, much broader than the S&P 500. On that date, over 90% of the stocks posted a positive return. Now you might think, oh, that's not a big deal. Well, in the course of the last 40 years or so, since 1980, that has only happened 24 times. Now, that isn't very often. And that really talks about the breadth of the market, meaning how many stocks are participating in this really great bull market, the positive momentum that's happening. So since 1980, that's happened about 24 times. A lot of those times happened in 1 month periods where the stock market was recovering off market bottoms. A lot of times those weren't really great markets, and this has really been a very positive couple, 3 years. So refocusing on the 90% advancer days, returns are typically quite positive over the next year. Constructive market environments, meaning that the participation of the breadth of the market are built on the shoulders of many stocks. So 2,300 stocks, 90% of them, or closer to 2,000 of those stocks, have posted positive gains on that one day. What happens 1 year later? Now, let's take this with a grain of salt, because certainly we can't be predictors of the market, but 1 year later, the average return after that 90% participation is a 24.1% return. I am not saying, again, that we're going to receive a 24% return, but since that date, since that August 22nd date, we have been up 5.89%. 5.89% in a little less than 3 months. That is an outstanding return. So we could certainly fall back. We could certainly have a 20% correction, especially with all the news about AI driving the market and a lot of volatility happening. But let's fall back on that idea that most times more breadth equal more constructive market environments, which ends up being a net positive into what would be regarded as a very volatile market. So we've had some great returns here recently. I'm referring, of course, to the breadth of market as the trend is your friend. And right now the trend has been pretty positive. We had one 20% decline in March of this year, but could we have another 20% market correction? Yeah, it happens about once a year. But so far, very positive returns. The other thing I wanted to mention is don't fight the Fed. The Fed lowered interest rates 1/4 point last Friday, and that's generally a very positive thing for the market. When money is cheaper or less expensive, big companies or even larger or smaller companies end up borrowing more money. So that leads to expansion of the company, whether they spend the money on marketing or a new fleet of vehicles or more salespeople. But lower interest rates usually mean market expansion. So stay tuned. We'll let you know what happens in the next month or two, because we also remember that just around the corner comes the Santa Claus effect, and fourth quarter traditionally is one of the better quarters of the year. Have a great Thanksgiving coming up. We have a lot to be grateful for, and I sure appreciate everybody tuning in, and we look forward to talking very soon. Have a great November, and we'll talk very soon. Bye-bye.